Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings and welcome to Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht, our options educator, mentor, trader extraordinaire. He is very active in not only educating through courses and mentorship. You can find him at LaDucTrading.com/Hans, also working with our members in our Slack membership space, as well as posting his trades. So we come together and kind of look at the market. I try to size it up from a macro standpoint. I have this kind of collective trade mindset of dollar yields, oil, and then how it impacts volatility and equities. So we'll kind of recap some of what's going on right now in the world, not just tariffs, but the reaction thereof and money rotating. All right, so then we kind of get into options tactics around particular plays. We can also answer questions. So hit us up in Zoom Q&A if you have any questions, macro to micro and option structure. We'll give it our best shot. Hans, how are you today?
I am well, Samantha. I guess we got a little update here, so that's nice for a change. But that's going to be typical of your volatile markets. You're going to get some rough closes and some good closes. So that's part of the scenery, I guess.
Yeah, we have a bunch of stuff going on as it relates to oil has definitely started to roll over. That is part and parcel of what the administration wants, but it may not be what oil companies want. That's a big focus that I have been on for the past few weeks because I sensed that we were going to have a pull down. The big level for me is this 65. I can give it in crude. I can give a little bit more details on that, but the gist of it is if we start breaking below those levels, we'll get another deflation impulse. In the meantime, yields definitely came back down, the 10-year in particular, into a 4.2 area. It actually overshot and then ricochet rabbit yesterday on a little bit more of, this is a tougher one, meaning the tariffs were implemented on Tuesday, and then LaDuc was out saying maybe we'll repeal or revoke whatever, some of them, but it was really geared toward the auto industry, which would be hardest hit U.S. auto manufacturers. So long story short, it was not all. But we also have a situation where yields are spiking abroad. So we have this amazing downdraft in the past 3 days, especially with the dollar, the US dollar. So relatively speaking, the euro dollar and the pound dollar pair trades have been spiking very aggressively on stimulus. So over there, they're going to kind of have to go it alone. Trump wants to pull out of NATO, although that takes 2/3 approval of Congress. This is not just a directive that he can do, but he can pull troops out and he can pull money out. So it is a de facto withdrawal. But Europe is not going to take that line down. They could, but they don't want to. So they have basically rallied around Ukraine and basically committed arms, soldiers, money, and let the conflict continue. And the result is they have to fund it. So they have basically issued this promise of debt, and this has spiked their yields. Long story short, money flows, path of least resistance, where they can get the most yield. US dollar has been falling with yields, with equities, with oil. So money has been rotating abroad, not just in the China space, because they're also doing stimulus, a little bit different, not the same fiscal stimulus, but they are absolutely trying to increase their banks, their citizens' confidence, and their stock market and capital markets, I should say. So China's really doing stealth and direct stimulus. Europe is now doing, Germany taking the lead in direct fiscal and monetary stimulus continued. So their yields are higher and money, that dollar is dropping like a rock as money is flowing elsewhere. So usually we get a little bit of a tailwind here with dollar down and equities popping, but this is a little bit different. It's actually our 10-year. So as our 10-year has bounced yesterday and today, that's actually that kind of inflationary thrust for assets. Stocks like it. It's short term. I don't think it's going to last, but that's exactly why bonds pulled back, yields took a little bounce, bringing equities higher. And this is really, unfortunately, I don't think going to be long lasting, but that's the market we're in. We've got some oil, support right now that needs to hold. We've got some yield support, that 4.2, the 10-year US that needs to hold. And we have the dollar around 104.5, 105, which doesn't really need to hold because the administration really does want it to fall. But I can see a situation where as we go into FOMC in a week, 2 weeks from today, and we'll be live for that, and as we go into potential government shutdown on the 14th, we could get some support in the dollar. But for right now, These are some sharp moves in the FX complex that have basically taken our worry right now, short term, from VIX spiking. And that's what I want to turn over to you. We're going to have a conversation about volatility because I don't think it's done.
Yeah, and I think what you're really alluding to, what you're talking about is this sort of, we've really seen a series of 180s. There's sort of, and of course, markets don't like uncertainty. Volatility doesn't like uncertainty, although the VIX could be a little bit higher in my opinion. But 180s, Europe being sort of a trash heap, and Germany, German economy, why, don't touch it with a 10-foot pole, and now it's making all-time highs, and you've got stocks like Rheinmetall going to the moon, right? Because everyone's because of, I guess Germany just having to foot its own bill for defense and pay its fair share. And so you've really sort of got this interesting 180 kind of world of things kind of flipping on their heads, even from the standpoint of post-Trump election. Everyone was kind of, this is fantastic. It's all about, he's going to love the stock market. He wants everyone to get rich and make money. He's just, it's going to be a big party. And then, we had this sort of little interesting what's happened in the last little while. We've seen this we've shifted from this upside inflation risk idea from some of the things that Trump is doing to very, very quickly becoming a growth shock idea. So really kind of almost, I remember you and I, it wasn't that long ago, we were talking about, well, there could be even, some people are chirping about rate hikes. And now we've got 3-4 rate cuts starting to be priced in. And so this idea that the Trump put is really not there, or at least the Trump put strike price is way, way out of the money. I mean, it is out of the money. And who was it? Lutnick, he came out, I wrote down this quote here. He came out and said, over the medium term, which is what we're focused on, it's a focus on Main Street. Wall Street's done great. Wall Street can continue to do fine, but we have a focus on small business and consumers. We're going to rebalance the economy. He's almost, and Trump sort of chirped something about that too. They're kind of saying this, and it's interesting to me, is that, the gap has become too wide, the haves and the have-nots, and this sort of is a sort of ticking time bomb over time that they want to address. So I think there's sort of very interesting how they're going about it. And they're saying, well, we don't mind a little bit of a reverse wealth effect. And that's not great for markets, right? The market doesn't like the reverse wealth effect. It likes to go up, thank you very much. And it wants everyone to do just fine, feeling richer from assets, either homes or market stocks going up. And so we're really dealing with this very, very new reality of something that could be a little bit more durable. I know the art of the deal involves, a lot of barking and saber rattling and then coming back and negotiating a little bit. But I think if you look underneath the surface, I don't know if you agree, Samantha, there is an effort afoot to really kind of toss aside some of the things that have been supported for the last 15 to 20 years, which is, hey, everybody just get richer and richer, and that's going to keep the economy going. And that is a threat. It's a threat to growth. It's a threat to multiple years of expanding record profit margins and companies being able to say, hey, it's inflation, don't worry, we can raise prices all we want. So there's a little bit of a threat to the market as we have known it for a little while now. And the question is, how durable is that going to be? I mean, maybe what if Trump just kind of tosses everything out and just says, you know what, let's go back to normal, which isn't going to happen. Does the market recover from there? Probably, but that's probably not going to happen at this point.
Actually, I think that we can have a very, very strong bounce. But first, we have to have honking big volatility. That's my baseline bet. So I want to make volatility great again before we actually buy the dip. So first, let me just...
Trump's doing it. Trump's helping you out, Samantha. He's your partner in crime there.
Well, it's definitely chaotic. I mean, I do feel that, the administration is chaotic. It's distracting. It's a lot of noise from the signal. We definitely have the deficits are still chaotic, which is the biggest problem. So the market will have a chance if we can actually get control of congressional spending, and that is not what's happening. So we talked about that.
So is that light at the end of the tunnel? Is at some point will the market
right now
refocus?
It's an oncoming train because they have not dealt with it. So because they're not dealing with the deficit, it is still an oncoming train. There's no question. Doge deregulation and drill baby drill is just not going to cut it. Drill baby drill is about lowering oil prices, which I already saw last year, right? I've been a bear since April of last year, doubled down that it's going to be misinterpreted as recession risk this year, that we're going to fall into that 60 to 40 range. And everyone's like, no. Navarro comes out yesterday and says, we would like oil down at 50. So if crude goes down to 50, there's not a lot of incentive for drilling. But nonetheless, nonetheless, their sound bites really sound good. So Doge really sounds exciting. It's going to save all kinds of money. It's not going to get the money back. But Congress still has the checkbook and the power, and they're saying, Supreme Court also ruled against Trump just a few hours earlier in his effort to stop the financing of U.S. aid, a very, very controversial black hole of money laundering. So the Supreme Court said, 5-4, you don't have the power. Really? Okay. So he's not having a lot of success in getting through this fiscal restructuring. So Doge right now is a donut for all intents and purposes. It has great potential, and it is, by the way, contributing to Trump's layoffs at the government. So we're still talking massive hit to the labor market, because obviously 45,000 out of 90,000 IRS agents, many will think it's a good start, but it's also VA just got hit with I forget how many, 70 something thousand. The point is government is shrinking, but without the spending shrinking, it's just going to hurt us. So we really have to get the deficit under control. The falling energy prices will be immediately seen as a recession risk. Unemployment, jobless claims continuing to trend higher will be seen as recession risk. We don't have deregulation's great, but it's mostly for corporations. And those prices from tariffs are getting passed down to consumers. So everything in the short term is very painful for consumers. It is inflationary in the short term. But longer term, higher prices are corrected with lower demand. So what fixes higher prices are higher prices. So
can he replace? So is he able to replace? He's thinking, well, I'm going to replace, any kind of, he's going to basically fund the tax cuts with tariffs. But then what about the impact on demand? And then so what do you have to do? Raise tariffs even more. So there's this sort of an endless game of this sort of endless spiral that doesn't really work, does it?
I really think he loves tariffs. Like he's really going back to 1919 kind of Woodrow Wilson times. But one thing that I had posted, and I think this is a great chart for anyone who wants to kind of get their arms around, what does this mean recession risk as it relates to fair value and SPX? Because we're not just talking about right now what's happening, which is chaotic headlines on tariffs and yields and war, conflict. What we're talking about right now is stock market clearly since Wednesday the 19th, because this is exactly when I started seeing underneath, just starting to roll over underneath the surface before the market actually did. Anyway, long story short, it's starting to get nervous about a recession. This is a chart by DataTrek. They do excellent analysis. I always pitch their service, and they are consensus bulls, by the way, because the market, as you are, right, a consensus bull. We have to navigate the twists and turns because we're more actionable. But for the most part, this is what's not getting priced in. Literally, we're up here just a few weeks ago, 62.50, the quarterly JP Morgan collar, what have you, price target expectation. There was not a re-rating of fundamentals based on disappointment in earnings. Now there has been. So as soon as we get PE multiple, can you see this chart okay?
Yes.
Okay, so as soon as we get, PE multiples, especially in the Mag 7, since they're such heavily weighted, see Nvidia, as soon as they start to come down, and as soon as we get percent decline in 2025 earnings estimate starts to come down, then you can kind of see this matrix. So, we were talking about already 4,700. That's not a huge level of concern. It'll probably pop up like a daisy. But the point is, then the next one will be lower, and then the low will be lower, and the next high will be lower high. You know what I'm saying? So we're gonna start working down through this matrix.
Right. That's the problem, is that markets are kind of, as we always talk about, perform at the margin. And the problem is the margin is fraying in a very durable way, as you're describing there. We could be looking at the same way we've been sort of propelled higher by sort of incessant record profits and sort of, against all, the sort of rate transmission mechanism, rates rising from almost zero, not really affecting the economy at all because of all this wealth that's been created. We may see an unraveling of that. So that doesn't sort itself out over 2 or 3 weeks or even a month or two. So that's the problem, is that we may have this sort of headline risk. And then, as you're saying, like the analysts are like lemmings, so they're going to start sort of piling on. And that's our problem with this market. So it really is hard to kind of construct a scenario where unless Trump just pulls completely another 180, it's hard to kind of construct a scenario where the market can overcome what is not just happening now, but the implication that it has in terms of your chart, your graph that you just showed there, over the next little while, it's our new reality is that this picture has very much changed, and that's very worrisome for markets. So we will see volatility probably. I'm sort of looking, I thought, when we rally into the end of the day, what I did was I was long a number of VIX structures. So the 20-30 call spread in March. March is coming to an end. So
Yes,
so
we
you
have to
kind of
add
have
some time.
yeah, you kind of have to be looking at April at this point if you want something that's going to give you a little bit of time. So I've had these March structures, which would have done better if this had happened kind of a month ago. Craig is saying, can you show that
I
chart
saw it.
again
Yeah,
and explain
I will.
excellent. And then plus I had some short put, long call, long 21s, 22. So what I did was I sold those out when we were around 25.5 on the VIX. That's not necessarily where the futures are. The futures are a little bit lower than that, right? So, but what I did was I rolled into an upside butterfly. So I rolled that. What that is monetizing some VIX calls that I made money on, and I rolled them into a 25, 35, 45 butterfly. And I think near the end of the day, I think in March, you can get those for about 35 cents. I think those are interesting. If we get a little bit more of a pop on the open tomorrow, if you think that we could get a pop and drop, which has been sort of typical, except for yesterday. Yesterday, the big interesting thing was you mentioned it in your live session in the morning. You said, we're finally getting the drop, and then we got the pop. But we've typically been getting these pops and then drops. So we cannot hold a rally for good reason. And I can show everyone in a moment when we switch over, but there's CTA selling, there's vol target fund selling. There is selling no matter what, just lurking below the surface. So I think you're right to figure that this is, I would be very skeptical of these rallies. And on a pop tomorrow, I'd be looking to maybe pick up even some of those Marches for a little bit of a reversal down into the 5,700s or low, down maybe a drop of 75, 80 points. And certainly I would be looking at adding some April at this point to maintain that hedge. VIX in the low 20s, given what's going on, that is not bad. And I've always said to people, I've said, listen, be careful with VIX. Everyone thinks the higher the vol, the more you should be selling the heck out of it, right? Oh, expensive options. The problem is low vol, low VIX can be expensive. A higher vol can be actually cheap, given what's going on. It is a relative product. It is relative to the underlying movement and risk that's going on. So be very careful. Do not think that a 22, 23 is expensive, because I do not think it is right now.
Interesting. Let me just show you a chart of VIX and VVIX, because most people think you cannot, technically analyze volatility. It is a structure, it's a skew, it's a this, it's a that. I technically see patterns, everything, everything. People too, especially people. Anyway, so I just want to show you VIX. Speaking of your cheap, I noticed this morning as well, these August, way out of the money, 42.50, cheap 50 calls with only it was a little lower earlier. It was like 77 with the IV, few hundred thousand contracts. Like, they're coming in still, and they're adding time. So they're still planning for a little bit of protection. But the point is, I wanted to say, technically speaking, when this started really in earnest, you could see that Friday, the fateful Friday, the 21st, it was the biggest selling of the year. This actually broke above the 200-day. I'm on a daily. And ever since then, it's really been staying in this nice little structure. Now, I have a rule of thumb. It's 1929. Market above is bearish. Market below is bullish. And we're firmly above 1929 in a nutshell. So I also, the other day, for clients said, okay, I don't scalp, but you do. So I'm going to tell you where it's safe to scalp. And this was, we get VIX back inside. This was literally on Tuesday. We get VIX back inside this 25.20. You're going to have a nice market bounce. And that was, of course, NASDAQ 100, 200-day. There was some basic.
I remember that. Yeah. I remember you saying that. Yeah.
So it's really not rocket science to scalp during the day if you've got some key levels, especially in VIX. But I want to show something, and I've shown this to clients for a few weeks now, and I don't know if I showed it here in our live session, but I will anyway. If you look over here, I spied early, and you can't tell now, but this is called a bullish engulfing of VVIX on the weekly. And the day before, Wednesday the 19th, was when I said Q's short underneath 539, and it wasn't rocket science. It was a really, really nice level to short against. I can show that. But the point is, I said below 539. And on Thursday, we had some selling. Volatility started coming up. And I said, this looks like on Friday, right here, you can see this wedge on a daily inside of a wedge on a weekly. So it was basically, for that Friday, we're going to go up here and tag that wedge. So it was really easy to say on Friday, that Lotto Friday of the 21st, guess what? we're going to have volatility. It's setting up and it's going to engulf this candle, the prior week's candle. So I'm using candlesticks. I love debating people who say you can't technically analyze a VIX chart. I'm analyzing a volatility of a volatility chart. Anyway, the point is, the chances are, and I said that on the Friday when we had the 21st, I said this is very bearish. It's not bullish. It's very bearish, the market. So we did follow through. And then just recently, we got right up into this kind of 125, poked above and came back in. And it looks like we're done. But that's not how this works. This can go, for the next few weeks before it gets into that wedge and does it again. But big picture, we clearly had a volatility event, but it was not big enough for my choosing. I don't want just 125 for VVIX. I want what we had back in August. Make volatility great again, and then the market is safe to buy. That's what I'm really, and by the way, oscillators are still bullish. That's a stochastic. It's an oscillator for those who don't know. Today, of course, we had on the aggregate, we had, call buying and put selling. That's always going to happen. But at the time that this was happening, we had massive, and we talked about it on that Wednesday, the 19th. We had a lot right back here on that 539, which just so happened to be a quarterly resistance and a prior week and a prior month. And anyway, it was really easy to say, okay, as long as you stay below 539, Qs are headed lower. And it worked. But the point is, they were also coming in and they were going deep in the money, right? The BRKB 500 puts back, out in August, and they were selling calls. So relatively speaking, back then, 2 weeks ago on this Wednesday, they came in and started buying aggressively puts at the money and selling calls above. That helped the whole market structure give sway. And then you add in all the other stuff that I use, which is breadth and net volume, et cetera, et cetera. But we talked about it 2 weeks ago, how they were coming in and they were getting into that place of protecting. We didn't really know why yet. Then volatility started to come up and then it really got busy, but it's petered out. So honestly, we need a macro trigger. I'm always on that. It's not going to be non-farm payrolls this Friday, I don't believe. Jobless claims will continue to trend higher. We have a week of Fed blackout, but Powell speaks on Friday. And then of course we just have headline risk and tariff terror, whatever Trump is going to next pump on the weekend for crypto. And it's really chaos, right? And the deficit's not under control. And all the bonds are doing are having a pullback at some key resistance levels. But the market right now still isn't safe. I would love to have a volatility surge that we could then buy the market, like with both hands. And then it'll have a reflexive convexity, short covering, whatever, rip to whatever level. We'll figure it out. But we don't have enough volatility for me to get excited about recommending or getting in here and buying the market. That's it in a nutshell. Make volatility great again.
I agree with you. And I think the VVIX is actually a little bit on the inexpensive side, given where VIX is and what's going on. So I think it could stand to get going. It's actually kind of a curiosity to me. I wouldn't have guessed it to sort of work out this way, because we have been talking about how that upside in VIX, dealers are really, really short that upside, that sort of convexity. And you would have thought, I would have thought that we would have definitely been over 30, given the sell-off that we had, sort of probably, 7% or so from the highs. Insane, but certainly happened relatively quickly, right? The VIX is about speed sometimes, right? If you look at something like, you've seen sort of difficult markets where the VIX hasn't been as reactive, because it's less tied to a specific strike. It's not saying, well, if the market goes below 5,900, then your puts are worth what they're worth. The VIX, it needs a little bit more shaky. It needs some shake and bake, as you say. It needs something crazy to be happening. It needs velocity. And that was fairly decent velocity there, fairly good, and particularly given the underlying nature of it, the underlying durability of what was going on. I will say, though, that in the short term there, we saw the 9-day VIX kind of exploding versus the VIX 30. So I like to follow those. And typically I like to see, if you guys want to chart that, you can go on stock charts and look at the VXST : VIX, $ in front of each of those. And you can kind of see that it tends to move between 0.75 and 1.2, 1.25. And a few weeks ago, I was teaching a class and I said, and I was showing them this indicator, and I said, listen, that 0.75 is getting a little bit on the calm side. You tend to see that when short-term volatility is so low that 30-day volatility kind of hangs in there. It doesn't want to drop anymore. Almost like realized volatility. When the market gets so quiet, the VIX won't drop from 10 to 9 or from 10 to 6. It will find a floor. And usually that distance between the two is something to be cautionary about. And sure enough, that was was pretty close to the bottom, and we got to 120, but just very briefly the last couple of days. So short term, it's kind of needs to unwind. I'd say when that gets closer to 1 again, when that 9-day VIX gets a little bit closer to 1, I think we're going to get another big sell-off. So there's some little tricks you can use in there. That's easy for anybody to follow.
You have a chart of that to show, because I have mine, which I think folks already know is this guy, just for giggles to show. And then you've got,
yeah, sure.
I have basically half a dozen that are right now trying to figure it out. So they don't say safe yet. One of them is this VIX 3-month, VIX ratio, which when it goes down here like it did with August and VIX itself hit 65, huge backwardation and a huge rubber band snap. So they came in and they sold puts aggressively, and we just had whoosh right back up. Now, this happened again recently, and it was a December little swoon there. If you remember, SPX lost 3% that day. So that was the reason for the season in why this particular ratio got right back into the August low. And then, by the way, ricochet rabbit higher and markets got supported. This one's taking a little bit longer. So this one has, by the way, just the other day, it was real time, so we happened to see it. My live trading room moderator and myself, it did come down into 0.9, but it has to stay there. So here's the trick. Yes, it did for a New York minute. And we had a little reflexive bounce. If you remember, we had like a 100-day intraday reversal. It ended up being a doji at the end. We basically had a lot of volatility intraday, a scalper's dream. Anyway, long story short, this is where it needs to come back, visibly come back into this backwardation, and then be a stronger buy. So for right now, we're just kind of playing games with VIX not getting too excited. And that means bears aren't pressing. And we're also not getting bulls very excited. I mean, it's okay. Let me just kind of show this.
It's not like the carry trade felt awful, but it was, you could almost think of it as a bit of a localized event. Maybe a furtherance of that, Japan continuing to do it to raise rates would have been an issue, but
and they say they will, by the way. Japan,
they will, right?
They're pissed. Yeah. They're pissed about tariffs. So they said, we're going to raise rates. And that will be very disruptive because of the US-Japan rate spread differential, which was the reason I recommended short. Remember the bank run in Japan? I forget their name, but the CEO had, he fired, quit, whatever. That was on the 20th. And I said, we will get volatility. It will come from abroad in this rate spread differential. It may or may not trigger yen carry trade unwind. That it's too early for that. I said, give it about 3 weeks. But in any case, right now we have bounced. I'm just showing you a 2-hour chart of the Qs, and we're trying to stabilize. I see that in my rate differential as well. We've got SPY that we could pull up here into about 592, and I still wouldn't trust it. So it's a scalper's delight. There's no question. And part of the reason, and people don't maybe understand this so well, is that one of the reasons is because yields bounced, and yields right now falling is very recessionary. So oil falling, as I mentioned, this was my trifecta, right? That we were going to have yields with oil, with equities dumping. And when they got a bid, this is actually what's helped the market stabilize. So assets are an inflationary thing. And so we need some stabilization in yields. And that's exactly what happened. By the way, all of these are on the 2-hour chart. That's the 10-year. Sorry to confuse. This is SPY. This is the Qs. It is trying to hold. But I have a bigger issue. FOMC is 2 weeks from today. And so far that 3-month, and the 2-year, the closer duration rate structures look very bearish to me. So I'm not excited about the market being so healthy. I actually think that we can have some more volatility through treasury volatility in addition to currency volatility. I'm still on the sidelines until I can get at least some kind of excitement because Fed funds that you just mentioned, right? They're pricing in, 76 basis point, whatever. It could rise. So I don't see hiking by the Fed. No. I actually see more of the potential of not emergency rate cuts, but like they did in September, where the yield crash, the 10-year, really fell precipitously into 3.6%. And the next day they came in and they didn't cut 25 basis points as expected. They surprised the market and cut 50 basis points. And that's what helped stabilize the market. Literally, that's what helped a yield spike. So right now we're in a different situation. We actually have a yield steepener. So we're actually starting to move higher in this steepener, which right now it's confusing, but it means that the short end is going to move a lot faster than the longer end. Okay, so what do you got for your volatility and skew and all that good jazz?
Trump and Papa Powell may see eye to eye pretty soon if Powell sort of feels the need. We're going to get rates down, which is what Trump wants. And so, but if you look at this VIX picture here, still very, very concerned. You can see the VIX cash, which is the one you see on TV, way above the futures curve, which is just slightly inverted here, but basically flat. So not it isn't super panicky. This isn't an '08 by any stretch of the imagination or anything. A lot of events even milder than that. It is flat and it is very, very worried. So there's no question that we are still pricing in quite a bit of volatility. Does that mean we can't get a 3-day up that makes you feel like everything's okay again? For sure, of course we could get that. We can't underestimate the ability for this market to climb a wall of worry, but a small wall it can jump over. The bigger wall is starting to get pretty high and pretty difficult to scale. And this is a bit of what happened. We talked about this last week, how once we sort of got closer to 5,800, that's where this sort of Vega, short gamma, short Vega situation really started to accelerate things to the downside, which got us almost down to that 200-day moving average. So these are definitely things to keep an eye on. We were in a very healthy, positive embrace of positive gamma up here, as we talked about not that long ago. But it's just been one thing after another. And so interesting, I was looking some of these macro numbers, macro systematic strength, still about 80th percentile long versus the average for the last 5 years. So there is a lot of stock potentially for sale, a lot of people sitting on that sell button. And I think this is part of the reason is that, look, your corporate capital spending, it's funny, we tend to think that, some of the things that take time to kind of unravel. And we're seeing a reaction quite quickly from a few different things. But we saw the Atlanta GDP, which is maybe import-export related to some extent. But look at this.
Partly.
Partly.
Yeah, I was defending it the first time. The first time it dipped negative, I was like, okay, calm down. You're all expecting a big slowdown. It really is exactly imports pulled forward. But then it came out with another negative print. And I'm like, okay, you're on your own. You're right.
Yeah, something's going on, right? And this is the problem is the wealth effect has really kind of kept this thing going, right? There's no question the lower half has been struggling for a long time, but people planning vacations, look at this falling off a cliff a little bit here. I mean, it was up to recently. I mean, we talked about it last week, 28 days of retail buying. I mean, people have been very, very, very bullish. We saw some parabolas on the optimism for where stocks were going to go. And that's when I pointed out a couple months ago, I said, this is not normal around December before we got that big sell-off. I said, there is some exuberance out there that is a little bit unnatural. That's part of the part of the problem is my 180 theory, that we've come from being so incredibly optimistic to suddenly facing down the train, as you said, kind of the oncoming train. It's not, I like that actually when you said the oncoming train. It's not light at the end of the tunnel. It's a train coming at you, right?
But I have to show you because it is sentiment, right? And we do have buybacks and we still do have the ballast of TGA, which is Treasury General Account. So there is still liquidity in there as it relates to the structure of the market. There are lots of headwinds. We stagflationary ISM today and in services, and ISM manufacturing on Friday was nasty. Contraction, less employment, higher prices. But the point is, this is still the sentiment where we can, and we have in the past, gone hot fire flames because everyone's on one side of the boat too quickly, right? So we then turn around, but I just don't see that right now, technically speaking, or in my intermarket stuff, right? So the yield curve, the rate spread differential, the volatility ratio, the growth value ratio, all that stuff says, I need time. This was too much too soon. We dumped 10% in the NASDAQ in the fastest, by the way, that was really important. The fastest 10% drawdown in the Qs, the top third, all. You saw it in 2008, you saw it in 2000, and then just recently from
Top
literally
three, no
yes, the
kidding.
top three. So I don't mean to have this on. My point is we can get these sentiment shifts that will drive the flow. We know this.
Yeah.
But, and that's how I can honestly tell you, I'm much, much better with timing tops than I am at picking bottoms. I'm telling you, I'm so much better at timing tops. So I look for anything I possibly can. Like today, I could see that they're definitely trying to sell some puts and buy some calls. It's a new structure. I can see that there's stabilization because a lot of my internal warnings that I gave on the 19th, literally, I gave my top 5 and I shared them here. And then we revisited them last Wednesday. I have my new top 5, and the point is they're trying to stabilize. Much, much, much happier instead of this choppy little space that we're going to be in into the end of the week and next week, potentially into the shutdown. I would much rather just have a solid volatility spike. I'm not going to get what I want potentially, but I'd rather have a volatility spike, and then we clear options expiration on March 21st, and then we can go in and tiptoe in.
It's possible. I think people are monetizing some hedges, so it's probably replenishing the dealers to some extent. So that's probably a little bit stabilizing as well. So we'll see if that continues. But you can see that vol control. So vol control for everyone is just basically when volatility drops, they start to allocate to markets, to stocks. And then when volatility starts to rise, so they basically it's a trigger. It's different for different funds, but if volatility rises, then they have to sell. So this is one of those things that's just kind of sort of self-perpetuating, right? If it's if volatility is dropping, they buy stocks, and then volatility drops more, and they buy more stocks. Well, guess what? This can go the other way as well. So the amazing thing is we're looking at a situation where I don't know where I have this chart, but it basically shows you that volatility is being sold no matter what. The stock market goes down, they're selling. The market goes up, they're selling. Probably related to your 10% sell-off there very, very quickly. Realized volatility has just simply gotten too high so that, they're basically locked and loaded to sell no matter what the market does. And it's the same for, many CTA strategies. They're just ready to sell. And then on top of that, which we sometimes talk about, is this massive leveraged ETF AUM. Right. So these are the things that happen to be very concentrated in Mag 7, in technology, in semiconductors. Right. There are a few other little things in there, too. But a lot of it is, when they issue these products, they don't issue it on something boring. They issue it on what's exciting and fun and generally things that are moving around. So the huge part of this AUM is in the things that have been struggling a little bit. And so this AUM has come down a little bit. But the problem with that is you get these rebalancings. Right. So on a big down day, you get these products having to sell a whole bunch. And then on an up day, it goes the other way. It's two-sided. You get the upside move being pushed higher. So that exacerbates volatility. And this is our new world, right? As we've talked about many times, this is our new world of short gamma and synthetic gamma like this. And that's our new reality. So we can see that in Nvidia, for example, I thought this was kind of interesting. We might be setting the table for an actual upside squeeze in Nvidia. Look, it's just short gamma right across the board there. If we could, for some reason, get going to the upside, it could potentially really go for a run. I'm not saying that's going to happen. I'm not super, super bullish on it, but gamma is really a reality that we're dealing with these days. And you can monitor something like that on spot gamma, or a couple places you can look at stuff like that. But very, very interesting. But look at this, what a difference from December, 40% no landing all the way down to basically it's all about growth. It's all about the growth scare. No growth scare, it was all about inflation. Now it's all about growth scare. And I think this is much more impactful, right? Markets can handle inflation to a certain extent, right? Because inflation gets passed on, whatever, it's doable. This is the much more pronounced problem in my view. So this is something that markets are going to have to deal with. So, and then this concentration, right? And I think this week I've been sort of thinking a little bit about, this also probably speaks to the chart that you love, Samantha, your growth to value. And we can see value starting to push through here. So I'm telling anybody who's willing to listen, expand your horizons. I'm not saying that there isn't a bounce in here somewhere. I mean, some of these mags have really gotten pushed back, and maybe there's some defensive nature to, as we've seen over time, these balance sheet heroes are certainly going to be a place to hide, a place to go because of their quality businesses, the quality of their earnings, et cetera. But at the same time, look around. As long as we're not going into a very severe downturn, look around. There's some interesting places to put money. So I think, if you look at just kind of an index like an SPLV, there's some interesting things that maybe you don't look at too much as some options for safety. I think it still has a reasonable amount of tech in it, and utilities, you got to be careful because of the power gen theme that's kind of embedded in there with the AI. But there's all kinds of interesting stuff in there, healthcare, et cetera, that I think that I'm starting to look at a little bit. So I'm rebalancing a couple of my portfolios. I have a Leaps portfolio that I'm putting together that I'm going to have some protection on, which is really cool. But it's funny when I start going through things, I'm like, oh, look, Microsoft's cheap. Look, and I keep going, and I go, okay, Hans, hold on a sec. You can't be all
You're
tech
not the
and
only one. Dan Niles, who I respect a great deal, who is a very, very in tune analyst, especially started out in semiconductors. So when he says, I am thinking about getting some of these now, and remember, his book is a little bit different than ours, but as it relates to they're on sale. But that doesn't mean they're cheap enough to buy until I feel that they have based and formed some type of, pattern here, macro and intermarket and technical and quant and all that jazz. Like I would love to play, Nvidia back and forth between this. I'm expecting 106, but right back up to 136 and then right back down and right back up. I mean, this is a channel chopping chase.
It's a trader's market.
Oh
Yeah,
my
it's
God,
a trader's
it's
market.
gorgeous.
Absolutely.
But to invest in this thing, this has gone nowhere. Literally, hold on, since May of 2024. So we're talking about a really long time where Nvidia has just been hovering around this 116 monthly line, which by the way is a really important line. If we close above, it's bullish. If we close below, it's bearish. Anyway, I think we have about 2 more months before Nvidia actually disappoints on their next earnings. They already are losing their profit margin. They're already losing their, their golden child status because of China tech coming in and stealing a lot of market share and a lot of their story narrative. But the point is, I don't think they're actually going to disappoint for another probably, until the next earnings. So we can be here sideways. Yes. And anyway, in answer to your question, someone asked early, I believe you said that SPX is going sideways for 2Q. I did, but I'm bearish in the second half. Do you have a predicted trading range? We're in it. Because I have an SPX target that I still think we're going to hit. 56.70. We haven't hit it yet. I would say we're probably going to hit it by the end of March, and then we'll see what happens. But yes, I think this sideways for right now for Q2 is a safe bet. And then I'm not bullish the end of the year. Okay, so let's see. We hit 6,100 just 2 weeks ago. I mean, that's exactly where we fell on Thursday the 20th is exactly where we broke. And then we had this swoosh on the 21st. Do we hit it again? I wouldn't be surprised. Honestly, you saw the sentiment tell. We're 60+% are now very, very bearish. And at some point, they're going to buy this dip. I just would prefer to have a nice big volatility trigger in order to buy the dip. That's what's bothering me. So that's what we're talking about. And as far as
feel
silver,
like you've just got to get that flush. You're just waiting for that one final flush that feels like everyone's liquidating, right? Everyone's kind of throwing in the towel. It kind of almost felt a little like that, yesterday, the day before yesterday, kind of felt a little flushy when we almost hit that 200. But I agree. I'm almost wondering if the VIX, if some of the risk gauges are really kind of throwing us that curveball and making us wait for this VIX 35.
We're not done going down. I'm convinced of it. I'm very patient woman. You know this. I'm very patient woman. We're not done going down. We need a VIX flush, period. I
was going to show you this. It'll get bought. I mean, in the back of my mind, I kind of almost wonder if we need to revisit that August 5th low, just because this is going to be, as we've been talking about, just really durable negative headline risk. Analyst lemmings piling on the the opposite side of the mountain thing as things are going down. They're going to have to cover their asses. So it's going to be just kind of a stream of potentially negative flow. So what you do here is you go VXST to $VIX. And so that's going to give you this, what I've been talking about, sort of looking for that 0.75 as a sign that things are maybe a little bit too calm, to the opposite, which is where we hit today. Okay, we did get a little higher today. So 122, 123, that's a pretty good spot there. So anywhere around 120 is really where maybe we're a little bit extended to the downside, almost like a Bollinger Band in a way, where you're kind of playing the bands a little bit, the extremes that the band is giving you. So that could be something easy that people can kind of keep in their chart list, especially if you're able to kind of keep that in your watch list as a ratio. That's kind of cool too. I'm with you, Samantha. I thank you to some extent too, is just kind of being negative on the whole energy. I got out of my XLE, out of my oil stocks. I thought, you know what, if this is going to be a difficult year, sometimes energy commodities maybe not a bad place to be, but given this sort of growth scare stuff and the fact that, peace in Russia, potentially more supply, these things aren't looking good. As good as these companies are in XLE, things just aren't looking that great for oil. So it may continue to be that heartbreaker that it has been for a very long time. It just cannot get going.
Intervention callers. So the problem is that it's not allowed to go, the underlying is not allowed to go too high or too low until Navarro spoke yesterday and said it what they really want to see, which is falling oil will pull down inflation expectations, will be an economic stimulus of sorts that'll help companies and individuals. That's their baseline bet. But to get there, there's absolutely short-term pain. OPEC's not going to like it, even if they get strong-armed. The U.S. drill, oh my goodness, they're not, that'll set off an oil industry recession. Long story short, they can say all kinds of stuff. But the problem is the timing for an oil short is much harder. Bob, our oil trader, he's very, very consistent in this. He's like, we're in this range, but money managers are not short. They liquidated their longs, but they're not short. There are better things to trade. And he keeps saying this over and over again. And it's a really, really good point. So even when I said, I feel like oil's going to dump, I'm like, it's going to take yields lower and equities lower. And I'm like, I hate having that trader's instinct sometimes because it was at 73. Now it's 65. But I don't have any reason for it, except I just know this is the trifecta. I watch this stuff all the time. Anyway, even though dollar dumped, oil still dumped. So my point is, it's a very, very tight trade. In the same way that we're going to not only get a yen carry trade unwind with an oil breaking that 62. So yen carry trade unwind part 2 is not an issue for me until we can break 62 in crude. So long story short, this is why I would love to have that volatility. But on the other side, I also know what happens when we get volatility. Some things can can really get hit. And right now, the rotation into Europe isn't because of tech. And of course, their defense contractors are getting bid up on sentiment. They don't even have a really large market, but it's because of stimulus. It's because of higher yields. And it's because, they're going to print and somebody said, okay, and America's going to make out because we're going to fund their debt. And I'm like, no, this is not World War II where we take their gold and, we do fine. And no, this is very different. This is not 1939. So I don't get the whole concept, honestly, of this being sustainable in Europe, this particular run higher in Germany, in DAX in particular. I think this will fall on itself. It'll be a kind of a fake breakout, fast failure. Not yet. Again, this is all about timing. And right now we're just kind of letting it play out until we get some more volatility.
Now, in terms of protection, I think, which of course is probably on everyone's mind, what do you do? Well, I kind of like the callers right now because I think you can kind of really pick that overhead area where you're generally okay limiting your upside. And because right now, of course, insurance is very expensive. So, even at the best of times, insurance is expensive in markets. So right now it's extremely expensive. And, the ability to maybe to try to get through, if you think they're going to kind of sort things out a little bit, I mean, I have my doubts. I think there's some durable problems being developed here, but you could look at something like, an Amazon. I mean, I love Amazon. It's a name that I've been buying some longer term options on. In fact, I've been adding, there are some tech names I'm really liking: Amazon, Netflix. I'm trying to think of companies that sort of have these really good moats. We talked a little bit about it last week, but also adding things like, Novo Nordisk and I was looking at IBB as well today because I think that's kind of an interesting place. I don't know. What do you like better, IBB or do you like XLV, Samantha, in terms of kind of the basket of having that healthcare?
100% of the time I'm going to answer XLV. The only time that IBB is going to do really well is one, falling rate environment. And right now we do have that, but for the wrong reasons. For economic slowdown. This is the dangerous part. So always used to be kind of an inverse trade. You go long the biotech because they're so dependent on lower yields and financing and vice versa. But now it's very different. So I have no interest in IBB. XLV has a lot of hardware. IHI is more direct hardware. So medical device plays have been great. We have been very bullish on Gilead and we're lucky. We've got Dr. Alexander Kenton, who's our resident doctor on our trading desk. So he is all over anything that is biotech. He'll do custom reports like the Tempest, the Pelosi pick, the healthcare proxies, which are not safe, like UNH and such. He's been really, really good about those, getting clients to be out of them, and then focusing on the medical device plays, which have been phenomenal. And there are some that are still trying to get up, but they look much, much better than biotech as an ETF sector. That was a long way of saying XLV over IBB any day.
XLV, yeah. Well, Medtronic, in fact, it's in the
Yes,
SPLV,
Medtronic.
which is a great, great company, amazing device maker, incredible balance sheet. So I'm just kind of trying to steer myself towards really, really solid balance sheets that are going to withstand what we're potentially up against over the next year, if it's going to be one of those difficult years. So, just kind of trying to pick and choose here. MSTR, I was trying to bring up my skew chart, but MSTR, I had my little fun skew indicator that
That's
kicked
right.
in
We got a
again.
crypto event tomorrow. Do you have any crypto trades into the Friday White House event? I have.
I do. I picked the wrong horse maybe here, because I said I put out my indicator and I said, listen, this is the spot at around 245 on MSTR. It went to 290, back to 235, and now it's at 308. So they're favoring. It's more Bitcoin focused, whereas coin is maybe a little bit all over the place. And I think the White House kind of said, well, it's not so much about all these other crap coins and all this stuff. So maybe that's kind of the difference between MSTR and coin. But I put on an upside broken butterfly on coin. I do feel like it can maybe march its way back up there. So I bought some around 215, and I bought some under 200 again. So I've got a really good cost basis on the upside fly. And I think that's a good way to play things right now. If you have a sort of directional view, you can kind of put on butterflies, because it gets very expensive to play things in this high vol environment. And they're also a nice way to limit your risk as well. So when we typically put on our finance plays, you still do have that upside. You've got the high, they're sort of high capital plays, selling it out of the money put. Although you can sell a put vertical, a bull put vertical, which is a way to limit that risk as well. But so long story short, I do have a decent amount of coin into this event, and I've been adding to Hood. I'm quite heavily in Hood right now. I think that's I like it for so many different reasons. We've talked about it before. So I'm in there. I think it's actually held in there quite well after the initial sort of $15 sell-off after earnings. So I think it's kind of hanging in there. And then I'm looking at things like DPZ. I bought some in the money calls on Domino's, which is of course a Buffett stock. Maybe not Buffett himself, but it's a Berkshire stock. Uber, I will not relent. I'm still good on Uber, and Netflix I mentioned. So just kind of trying to pick away Reddit. Of course, Reddit's really has been a star lately. It came down after earnings, but in the face of all this volatility, it really is kind of hanging in there. So I think that's a story that can still, I think they're doing so well that regardless of where the economy goes, I think they continue to grab market share. So I think everybody just has to sort of really pick their spots, be a little bit careful. Don't keep smacking your head against a wall on something that isn't working, like whatever it is, AMD or whatever,
or
pick
just
your
wait
spots.
until we get a proper flush. I mean, there are people who love this for the scalping and for the high IV, for income generation, what have you. I mean, obviously we're active, but for those who are kind of just looking at, wait a minute, where do I have to rebalance? One of the ways is just to kind of push away from this until we do get some good volatility or a solid breakout higher, like one that breaks out, retests, and keeps going, and we have a good reason for it. Right now, there's a lot of short-term pain in the market as it relates to, of course, tariffs, to be or not to be, and where they were going to be rolled out slowly and then all at once. Retaliation, trade war. China is really angry. Maybe this is going to be leverage and everything's going to be copacetic, but there are ramifications that already are being felt in retaliation by Canada and by China that are not going to be consumer friendly. And companies have to plan accordingly and tighten up and labor shed and all of that. Government firings will continue until morale improves. And basically that means ancillary government contractors and contracts are going bye-bye unless there's, the administration is sued, like in the Supreme Court, and they upheld USAID payments 5-4, then we really, they didn't get very far. But the point is Congress is still pushing through a raised debt ceiling where we're going to be pushing into $4 trillion over the next 10 years. That is very bad for bonds, big picture. It's very bad for our monetary system, big picture. The risks don't go away. The opportunities are if they can get control of this tariff trauma and the tax cuts pushed forward and deficit spending under control and doesn't tickle conflict even more in the EU or, God forbid, with China. The point is we have this market that is in the stasis of constant worry and constantly trying to figure out what the headlines are going to really mean to market returns. And right now, recession risk, as I showed with that one grid, was not being priced in. And it really, really, really should be a little bit more, because the fundamentals are starting to change. Nobody really has a model on what's going to happen in the first 180 days of the administration. It seems very much like the market will be gripped in this sideways. That's my baseline bet. I would prefer, before recommending to clients to kind of go in there and buy these things that are discounted, to have a nice proper flush, and then we can go back in, and then we'll be triggered by option flow, we'll be triggered by buybacks, by sentiment being too one-sided, and they all come in and they're all very excited. But I will remind, all that retail money that flew into Nvidia, the strongest impulse of retail money that flew into Nvidia just 1 month ago is purging, right? So they're underwater. So the point is, this is what the market does, and it was a sold to you market. It will be again. We're in a topping process. Long story short, I think this is going to be very chaotic, and I'm here for it. Hans is here for it. We'll help clients navigate through it, but it's definitely not going to be an investor's dream. We're not going straight up or straight down. How's that?
It is, exactly. As I like to say, just understand where your torque is. Know what Greek you're dealing with if you're trading options. At times it's going to be theta when you're just watching the paint dry, and at times it's going to be like this. It's going to be delta. It's going to be gamma. It's going to be vega. You're going to sell high vol. You're going to buy it back. It's a market in movement. It's volatility. So you've got to trade the volatility, even if you're going to be selling out positions, even though something looks fantastic, and you're going to be covering shorts, even though it looks like it's the end of the world. But that's what you do. And the great thing is, it's going to be the world of opportunity in these kinds of environments is great. It's like streetcar. There's going to be another one along any moment. So don't just grab what you can.
I've got to answer a few questions. First and foremost, this is my particular flavor on a gold silver ratio. It's a little tweet, but just go with me. This is the 2011, high everyone knows about. And then this was the most bullish chart for anyone who follows me on Twitter. I put this out because I really expected this to be a beautiful breakout, kind of like we happened to break out very, very aggressively in March of last year, if you recall, this big stick figure right here. And this is basically silver, then followed a month later. It had Jeffrey was all over this, our economics advisor. He really trades precious metals and bonds and foreign markets better than anybody I know. Anyway, this is something that exploded higher. We had a little pullback to support. Now we're extended. So in answer to your question, you got a whole bunch of them in here, but basically, is this the year for silver miners? Finally, they're in like second or third inning, and it's a longer period of time that this takes. So I don't know what your investment horizon is, but this particular gold silver ratio is on a monthly. So like, I'm not looking at this as a day trade. I'm not looking at this as a multi-week trade. I'm looking at this as a multi-month, multi-year trade. Gold and silver are in trend. If you're looking at a shorter time frame, you kind of got to let me know. Wheaton, for example, long since last precious metals. I mean, look at this thing. It's stunningly gorgeous, and it still continues. So it depends on your miner. They're not all created equal. This AGI is also gorgeous, was also one of the ones recommended. But the point is, I like miners, but they're also going to have some indigestion. And right now, silver is a little bit tricky, not just today. It went hot fire flames. And by the way, I am wrong-sided on this. I thought we were going to have follow-through. When we had selling in gold and silver last week, I thought we were going to follow through down here. We did not. So right now, my short duration timing on this gold and silver trade is not so hot. My trend trade is very hot. So to answer your question, it's fine. And the more depreciate the dollar, devalue the dollar, then obviously gold is fine. Right now, if they were to, and I should show you continuous contract, if they were to actually pull out of these conflicts abroad, I'm trying to show you gold continuous contract, then gold would fall. Precious metals would actually fall. Here it is. Okay. But guess what happened? Just as war is peace and we were having gold pull back, boom, Europe is going to do stimulus and support the conflict, et cetera, et cetera. So hopefully that helps you. I already said, yes, I saw SPX going sideways the beginning of the year and then rolling over towards the second half, and recession risk gets pulled forward. So far, nothing has changed. As it relates to SPX and NDX outlook, that's it. Capital flows right now are leaving because they're chasing yields elsewhere. Some of it's also going into China, and basically we'll have to see how far that goes. But this is capital flows that you can see. This is the dollar on a weekly. This is the dollar on a daily. 1, 2, 3. It'll have a ricochet. It'll have a little bounce here back up into 105. This is money flow right there. As it relates to sectors, I'm not fond of biotech. I'm sector rotation. So I go when growth is in vogue, I will absolutely position clients long for growth. If value's in vogue, then we position for value. Right now, value has been leading growth by a nautical mile. When neither growth nor value leads, we get volatility. I'm waiting for volatility before growth is another solid buy. And when it comes to Europe, what are the most attractive markets? Poland, actually Italy. She said she's not going to send any troops or money for Ukraine. She's probably going to fare better, honestly. And I did answer everything except, do I see Nvidia under 60 this year? Do I see Nvidia under 60 this year? I definitely see 90. So here's Nvidia, bigger picture, 90. I definitely see 90. We talked about that. I'm going to wait on that one because I think this is going to take another 2 months before we actually get disappointment from Nvidia and we head back down to that 90. If we break 90, then sure, we're going to head back actually lower. It's too early right now. Positioning for 90 is basically positioning for an economic crash, and I'm not there yet. I hope that answers all your questions, and it's way late. Hans, thank you so much. We'll do this again next week, and then we'll have FOMC, and we'll recap on the 19th, right before options expiration, month end, which is a big quarterly one. You'll get to tell us all about that next Wednesday so folks can prepare for options X. And thank you so much, everyone, for joining and sticking around, and hope that was helpful. All right.
Thanks, everyone. Stay safe.
Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.